The night the world ran out of money.
Everyone blames reckless homeowners or greedy bankers in striped suits for the 2008 collapse. But that's not even close to the real reason the world almost ended. But the real cause is way darker. If you think the economy works the way your high school textbook taught you, with supply, demand, and steady hands at the Federal Reserve, you've already lost the game. This disaster didn't just happen. It was a mathematical inevitability engineered by people who thought they were too smart to fail. The truth is way uglier than the official history, and it gets worse and much more expensive. Imagine waking up in a world where the ATM gives you a blank stare. Banks were collapsing faster than people could panic, and the digital numbers in your savings account were evaporating like they had a personal grudge against your future. It wasn't just a housing crash. It was the night the world quietly realized that money itself, something we all trusted without question, had almost stopped working. Picture this. September 2008. The air in New York and London didn't just feel tense. It felt terminal. Traders in New York are glued to their screens, phones pressed to their ears, voices low and tense. In London, it's already afternoon, and bankers are skipping lunch, watching numbers flicker like heart monitors in an ICU. In Tokyo, the day is ending, but no one is going home. Something invisible is spreading through the global financial system, a shadow that no one wanted to be the first to call by its real name. Banks aren't lending to each other anymore. Not overnight, not for an hour, not at any price. Even the world's top economists were panicking, which is rare because they're usually confused, not scared. This is what panic looks like in a world run by spreadsheets. People were panicking, banks were melting, and economists were pretending they had a plan. Governments kept saying the system was sound, but behind closed doors, central bankers were staring at charts that made no sense. Interest rates between banks, normally boring, stable, predictable, were exploding. The plumbing of global finance was clogged, and the water was rising fast. Officially, they blamed subprime mortgages, risky home loans given to people who couldn't afford them, adjustable rates, teaser payments, bad credit. That's the story that made the headlines. It was simple, clean, morally satisfying. Greedy lenders met irresponsible borrowers, and gravity did the rest. Except that wasn't the truth, because if this were just about mortgages, it would have stayed in the housing market. A painful recession, yes, but not a global financial cardiac arrest. But that is only the version they want you to remember because it puts the blame on the average person. It's a convenient lie. In reality, the housing market was just the fuse. Mortgages didn't freeze the world's credit markets overnight. Something else did. And the hidden reason is much worse. Behind the scenes, the global financial system had been quietly rewired over decades. Banks no longer waited for deposits before making loans. They borrowed short-term money from other banks, money market funds, and shadow institutions. Overnight, weekly, constantly rolling the debt forward. This was called the wholesale funding market, and it was enormous. By 2007, major investment banks like Lehman Brothers were borrowing tens of billions of dollars every single day just to stay alive. This system only worked if trust never broke. But trust is fragile. The dirty secret was leverage layered on leverage. Mortgages were sliced into mortgage-backed securities. Those were sliced again into collateralized debt obligations. Then came synthetic CDOs, bets on bets, insurance on insurance. The actual bomb was a complex web of financial derivatives called credit default swaps and collateralized debt obligations. These were instruments so complex that even the people selling them didn't understand the math behind them. They had turned the entire global economy into a giant casino where the house was betting with your life savings. Because here's the part they never mention in the news retrospectives. This wasn't a crash in the traditional sense. It was a complete seizure of the heart. And this is where the story gets suspicious. The real reason the world ran out of money wasn't because the money disappeared. It was because trust vanished. Behind closed doors, the dirty secret was that the biggest banks on earth stopped lending to each other. In the financial world, banks trade cash overnight to keep the gears turning. But by mid-2008, every major CEO realized that their assets were actually bags of toxic garbage. And that's not even the craziest part. The real breaking point came not from losses, but from uncertainty. No one knew who was exposed. No one trusted anyone else's balance sheet. And in a system built entirely on short-term trust, uncertainty is lethal. They looked at their peers at Lehman Brothers, Merrill Lynch, and Goldman Sachs and realized, if I'm lying about how much money I have, they must be lying too. This wasn't an accident. It was a ticking time bomb created by a decade of banking manipulation and a reckless hunger for short-term bonuses. Everyone involved pretended the bomb didn't exist until the smell of smoke became impossible to ignore. It was like watching a group of toddlers juggle chainsaws while yelling, "Trust me, I've got this." But the craziest part is still coming. Because this next detail changes everything you think you know about who was actually in charge during the collapse. The greed led to warning signs, the warning signs led to denial, and the denial led to a total explosion. When Lehman Brothers filed for bankruptcy on September 15th, the chain reaction was instantaneous. This wasn't just about stocks going down, it was about the plumbing of civilization breaking. Global trade began to freeze. Ships stopped moving because the letters of credit required to unload cargo were suddenly worthless. It was the largest bankruptcy in U.S. history, over $600 billion in assets. The government let it fail to teach the market a lesson. Instead, the market learned a different one. If Lehman could go under, anyone could. By 2008, the notional value of credit default swaps, essentially side bets on whether loans would fail, had ballooned to over $60 trillion, more than the entire global economy at the time. Most of this didn't sit on bank balance sheets in plain sight. It lived in the shadows, in off-balance sheet vehicles, special purpose entities, and models that assumed housing prices would never fall nationwide. Ever. And then they did. On a Tuesday night in September, the money market funds, the safest place on earth to keep cash, began to break the buck. This is when markets froze completely. Investors realized they weren't just losing profit, they were trapped in a burning building with no exits. In the halls of the U.S. Treasury, the atmosphere was cinematic. Hank Paulson, the Treasury Secretary, was literally on his knees at one point, begging for a bailout package to save the system from total disintegration. If money could scream, this is the moment it would have lost its voice. The digital ledger of humanity was one keystroke away from being wiped clean. When U.S. home prices started falling in 2006 and 2007, the losses didn't hit all at once. They crept. Quietly. A few hedge funds collapsed. Then Bear Stearns had to be rescued in March 2008. Officials said it was contained, a one-off, a lesson learned, but the system was already infected. Some experts still argue today that it wasn't a crisis at all. It was a robbery wearing a crisis costume, where the perpetrators were the only ones given a life jacket. The consequence wasn't just a loss of wealth, it was the birth of a deep, permanent anger that still fuels global politics today. This is the moment the world held its breath. But here's the detail everyone ignores when they talk about the recovery. This is the part that still affects your bank account, your rent, and your future today. People think the crisis ended when the stock market went back up, but the financial scars never healed. They were just covered with expensive bandages. To save the world, central banks printed trillions of dollars out of thin air, a process they called quantitative easing. Your cost of living today? The reason a house costs 10 times a salary? Yeah. You can thank the decisions made in those panicked rooms back in 2008. They didn't fix the problem, they just pushed the debt onto the next generation. This event impacts your life right now, even if you were too young to remember the headlines. It was a transfer of wealth so massive it makes the Gilded Age look like a lemonade stand. At the end of the day, finance isn't about numbers or complicated algorithms. It's human behavior dressed in a suit, fueled by the same ego and fear that has driven us since we lived in caves. Money isn't the problem, people are. Every crisis teaches the same brutal lesson. Greed always wins the short game and destroys the long one. We live in a system built on the illusion of stability, and 2008 showed us how thin that ice really is. And if you think this story is insane, wait until you hear what happened when the world tried to print its way out of the next one. The files are always open. Subscribe to keep digging.